Muted.
Hello, everyone. My name is Lily Mehta, Head of Marketing with CFRA. I would like to welcome you to today's webinar. The second half outlook, will tech keep the market's head above water? During today's session, you will hear from CFRA's leading experts as they provide a look at S&P 500 and sector earnings and valuations, highlighting those sectors in which CFRA recently became more positive, most notably energy and technology. Moderating today's session is Scott Kessler, Director of Equity Research and Analyst at CFRA. Joining Scott are three of our leading experts. First, Sam Stovall is Chief Investment Strategist of U.S. Equity Strategy at CFRA. Next, we have Lindsay Bell, Investment Strategist at CFRA. And finally, Todd Rosenbluth, Director of ETF and Mutual Fund Research at CFRA. Before we get started, I wanted to remind you that today's session is being recorded and a link to the recording will be made available within the next few business days. During today's sessions, you may submit questions using the GoToWebinar panel, and we will do our very best to answer as many of those questions as we can. With that, I will pass it on to you, Scott.
Right. Sorry, that was muted. We're doing this right over. Thanks a lot, Lily, and welcome everyone to today's webinar. I'm Scott Kessler, Director of Equity Research at CFRA, and as Lily indicated, I'll be moderating today's webinar. Initially, I want to highlight that we have a really great group of presenters for you today. Sam Stovall is CFRA's Chief Investment Strategist and Chairman of our Investment Policy Committee. Lindsay Bell is an investment strategist at CFRA and leads our portfolio committee. Todd Rosenbluth heads up CFRA's ETF and mutual fund research efforts. Sam, Lindsay, and Todd are all thought leaders and experts regularly relied on by CFRA's clients and end users, as well as our friends in the financial media. Collectively, and this is going to sound like a big number, but they have over half a century of experience with CFRA and the predecessor business at S&P Global. All right, so let's move on to today's agenda briefly. Okay, so you can see the number of topics that we're going to go through. I am going to quickly go through agenda item number 1, which is giving you some details about CFRA. CFRA is one of the world's largest independent investment research firms. What sets us apart, among other things, is our large and experienced team of analysts, our proprietary methodology, our expansive coverage, our proven performance track record, and importantly, our independence and objectivity. You may have known the CFRA brand for decades, or perhaps are just getting to know us, but it's worth highlighting that we've enjoyed working with many leading clients around the world in areas including wealth management, institutional, and insurance. Let's now hear from Sam Stovall, who, as I mentioned, is CFRA's Chief Investment Strategist. Sam?
Hello there, Scott. Thanks for the intro, and thank you, everybody, for tuning in. I do have a question, though, Scott. When you said that we have more than half a century of experience, why did everybody look at me? Anyway, I'll try to focus that into today's conversation. So the question, obviously, is what's going to happen for the second half? Well, I think in order to get an idea as to what's going to happen in the coming 6 months, we need to quickly review what happened in the prior 6 months. So let's take a look at the first slide, which talks about what were the first half returns. And in summary, it was basically the small cap stocks and the cyclical groups that led the way. Also, it's the domestic side of the equation, not the international, that did very well. In terms of regions, the S&P Composite 1500 was up 2%, whereas the Global 1200 was down 1.1%. By size, small caps up nearly 9%, mid caps up about 3%, and the 500 up less than 2%. And then when dealing with sectors, the three best performers were consumer discretionary and tech, up about 10% each, followed by energy. And the worst performers were telecom services, consumer staples, and industrials. And for those who owned Netflix or Amazon in the internet and direct marketing retail, that group did the best, up almost 50% in 6 months. Department stores, Macy's, JCPenney, up almost 32%. Application software, companies like Adobe, like Oracle, et cetera, up nearly 30%. Whereas we had housewares and specialties, tobaccos, tire and rubber, put the brakes on their advance, down about 20% or more. Now, the first question is, gee, is that inconsistent with what's been going on a macro basis? What we've been seeing is the Fed raising interest rates, most recently having done so twice in the first 6 months. We think they'll be raising rates 2 more times this year and 3 times in 2019. Well, going back to 1989, or I should say 1970, looking at company data brought up to the sector level up until 1989, and then using S&P sector level data, this is average monthly total returns for the sectors within the S&P 500 whenever the yield on the 10-year note was higher from 1 month to the next. So with technology and consumer discretionary each up close to 10% in the first half, not surprising from a historical perspective that they are among the leaders. Energy and materials also tend to do relatively well as they are inflation hedges, whereas it is the higher yielding, more defensive areas, financials, real estate, staples, telecom, that have posted the smallest gains, and the bond proxy utilities, the only ones that on average have posted declines. So in a sense, you can say that what happened in the first 6 months was relatively consistent with what had happened normally in a rising rate environment. So what do we have to look forward to in the coming 6 months of the year? Well, first off, history tells us to fasten our safety belts, because we have an acceleration of volatility likely to be experienced in the third quarter of this midterm election year. The one word that describes midterm election years is uncertainty. Historically, we find that the party in power tends to lose 22 seats in the House, loses 4 seats in the Senate. Both numbers would challenge the Republican control in both houses of Congress. As a result, investors typically have caused the S&P 500 to post a 34% increase in average daily price volatility in the third quarter of midterm election years as compared with third quarters of non-midterm election years. Taking that one step further, the first three columns, we see midterm election years going back to Harry Truman in 1946. The 6 months leading up to the actual midterm election, the market was down 1.1% on all observations and down 3% on average whenever it was the first term of a presidency. Also, the batting average was not very favorable, meaning that the market was down 50% of the time during all midterm election 6-month periods leading up to the election itself. And for first-term presidents, the market was down 60% of the time, so frequency of advance only 40%. But whenever we look at negative data, I like to say, yeah, but how can there be positives that can be derived from this? Or in other words, if life gives me lemons, how do I turn them into whiskey sours? Well, take a look at the two right-hand columns and you find that 12 months after the uncertainty has been lifted, 12 months after these midterm elections have run their course, the S&P 500 was up an average of 16.6%, 19% following the elections in first-term administrations, and the market was up 100% of the time in both situations. Obviously, that's not a guarantee as to what will happen this time going forward, but it, I think, gives us a reason to feel that uncertainty really is a big weight that investors have to endure. So summarizing our outlooks, we have a 12-month price target for the S&P 500 of 3,000, which is a single-digit price advance year on year, but still we're coming out of the correction that we experienced starting on January 26th of this year. Globally, we see GDP rising 3.9% this year, 4% next year. U.S. GDP is still expected to be positive in both years by 3%. We don't see inflation running away with itself, up 2.5% year on year, December over December for the end of next year. Yes, the Fed will be pushing interest rates higher, but still likely below the longer-term average, which traditionally is 1.3 percentage points above the year-on-year change in core CPI. Or in other words, we should be closer to 3.8%, not 2.8% by the end of next year. 10-year yield normally is about 2 percentage points above that for the inflation rate. So we really are looking at 10-year yield below the normal reading, but 3.4% is our estimate for the end of next year. Oil prices, obviously very challenging to get a grip on right now, above $70 a barrel. We think we'll average 68 this year, 72 next year, but obviously that number is quite fluid. The exchange rate undulating between 88 and 89. We've already seen the strength that we think will be maintained. Revenue growth up about 7.5% for all of this year, less than 4% for next year, but earnings expected to still be in double-digit territory, but obviously that number will be changing as S&P Capital IQ consensus data comes out with new numbers as second quarter earnings are being reported. The question I frequently get is, will small caps continue to do fairly well going forward? And my answer is yes. First off, because they are experiencing a reversion to the mean. They underperformed last year, so investors were looking for opportunities this year. They are the primary beneficiaries of the tax reform of 2017, since that aids domestically generated earnings, and a majority of earnings for small companies come from the U.S., not from overseas. That also helps during this era of heightened trade tensions, because if we have less foreign exposure, less of those earnings will be subject to tariffs, etc., and also will not be adversely affected by a strengthening dollar. So this line chart shows that we are trading at more than an 8% discount to the median relative PE over the past 20 plus years for small cap stocks. And so as a result, we still believe that an overweighting for small caps will be appropriate for investors. So with that, I will pass it over to Lindsay, who will talk about earnings outlooks for the market and sectors, and then also mention those sectors that we happen to favor currently.
Thanks, Sam. So I decided I'll dig right into the sectors to get started. So looking at my first slide here, it's kind of an earnings snapshot of where we've been and where we're going. And we've come quite a long way since the earnings recession from Q3 2015 through Q2 2016. We're officially 2 years beyond that, and we're expected to see earnings growth in the second quarter of 19.4%. Of course, the acceleration in earnings growth this year has really been a result of tax reform and fiscal stimulus. And we believe this is actually the second time that earnings estimates have moved higher ahead of the earnings reporting period. Usually you see numbers come down by 150 basis points going into the reporting period. This time we're seeing numbers up about 50 basis points in the 6 weeks prior. And when we look out to the second half of the year, earnings growth is expected to remain solid, averaging about 19.9% in the third and fourth quarter. And this is really impressive growth. When we look back at history, 2017, we saw earnings growth of 11.9%. This is the first time we've seen annual earnings growth of over 20% or even over double digits since 2010 and 11. And really that was related to a rebound in really weak numbers coming off the latest recession. So let's dig in on the next slide. To the sectors that are driving second quarter earnings growth, which will begin in earnest on Friday when we get some of the large cap banks reporting results. We're going to see another quarter of cyclical sectors leading growth. This is the fifth quarter in a row. Energy leading the pack at 140.5% growth. That, again, this is a sector that is coming off of 2 years of negative earnings growth, so that's why that number is so impressive. 7 sectors of the 11, as you see here, are showing double-digit earnings growth. You only have 2 sectors that are showing declines, that's real estate and utilities, and then the defensives are kind of in the middle of the pack there with high single-digit earnings growth. When I look at the top of this slide and I look back at where the numbers have been moving, as I mentioned earlier, that 19.4% number is up about 50 basis points in the last 6 weeks, and that's really been driven by tech, financials, materials, and energy. These are the only 4 sectors whose numbers have moved higher in the last 6 weeks, really kind of reiterating the strength that is expected from these sectors. All other sectors have seen that growth rate come down quite a bit, which is really the normal course of business when you're going into earnings season. But turning to the next slide, earnings usually, the estimates at this point of the season are usually setting quite a low bar. Every single quarter going back to 2009, earnings growth rates, the actual end result, has been better than expectations at the start of the season. You see this third column under the growth estimates that I show here. Says season start. That's where earnings growth was at the start of earnings season. And you'll notice if you compare that number to the number before it, to the left of it, at the beginning of the quarter, you've seen those growth numbers go down every single quarter except Q1 2018, where we went from 10.4% expected growth at the beginning of the quarter, which would be January 1 in that case, to the season start, which happened to be April 12th. Expectations moved all the way up to 16.3%, and we ended at 23.3%. Now, if we move down to the lower right-hand corner of this chart, you see the 5-year average beat rate and the 10-year average beat rate in basis points. So you could say, on average, we usually see earnings estimates end about 3.5 to 4.5 percentage points better than that number in the season start column. So if that were to happen this quarter, that 19.4% could turn into 23% earnings growth. That would be the second quarter in a row for a 20% earnings growth rate or better. And I do think that we are quite on track to reach that. So far, there's only been about 21 companies that have reported earnings results to date. 90% of those companies, it's still early in the season and I understand that, but 90% have beat on their top line estimates, and they've also 90% of them have beat on their bottom line estimates. That's a pretty impressive number even at this time of the season. You usually start with pretty high beat rates and it kind of comes down as we progress. But most importantly, guidance has been very good so far quarter to date. We've had several companies reaffirm guidance. FedEx was one of the earliest reporters, and they are a very global company, as we all know. They reiterated their outlook for GDP for not only the U.S., but also globally for this year and next. You know, they did note that trade tensions are a concern, but as of now, they've reaffirmed. Today, we got PepsiCo reported earnings. Nordstrom just also reiterated, both these firms reiterating their guidance. So the outlook so far is very good. Moving on to valuations. This is just a chart of the forward PE of the S&P 500. You see it's come down quite a bit since that January peak. In January, the S&P 500 was trading at about 19.2 times. Today, we've moved down to 16.8. That's about in line with its 5-year average, as I mentioned on the slide. In 2017, this index traded at 18.3 times. So we've come down. Even in 2016, we were at 17.1 times. Importantly, though, we will be watching stock reactions to the earnings reports this quarter. Last quarter, what I find notable is last quarter stocks really didn't react much to very, very good earnings reports. As I showed you, the numbers came in significantly higher than initial estimates, 700 basis points better than initially expected. But the stocks did not, it was a sell the news type of environment at that point in time. This year, the month heading into earnings, we've seen the S&P 500 remain about flat, and we're seeing better reactions to these beats that are coming across. As I mentioned before, 90% of companies are beating. So far, on average, stocks are moving up 1.5 percentage points in reaction to their earnings results, being led by the consumer discretionary and industrial sector. I find the industrial sector interesting. We are overweight that sector right now, but it is the third worst performing sector year to date. And I think that the reactions of these companies their stocks are moving up about 4 percentage points in reaction, or excuse me, 1.4 percentage points in reaction to earnings results. I think that tells me that some of these stocks have sold off way too much in reaction, probably to tariff talks. Consumer discretionary has also been another sector that has shown very positive reactions to the early earnings reports. Now I'm going to dig into a couple sectors that we favor and we'll be watching very closely during the earnings season. In early May, we upgraded technology and energy to overweight from market weight. So I'll start with tech because it does represent currently about 26% of the S&P 500. It has been in the top 3 EPS growth sectors for the past 7 quarters. They've reported double-digit earnings growth in the past 8 quarters. And since the first quarter of 2017, this will be the 5th quarter in a row that this group reports EPS growth of better than 21%, the current estimate at 23.1%. We've had a couple of these companies report earnings so far. We know that this is the best performing sector from a price performance perspective in the S&P 500 on a year-to-date basis, with the sector up 13.6%. It's trading at a PE of 19.1 times, which is about in line with historical averages. Every company that has reported so far, again, still in very early stages, every single one has beat its top line estimates. 83 have beat on the bottom line. This is expected to be the 4th best earnings growth performer in the quarter. As you see, semiconductors expected to lead the way with 37.3% growth. Micron Technology already reported they beat estimates, they raised guidance. It was a superior result. This sector, though, however, has been severely impacted by trade talks and trade tips as many of these companies sell their products into China. The largest companies, or the companies expected to post the largest growth in earnings in the first quarter within the semiconductor space outside of Micron, which saw earnings improve 94% year over year. You've got AMD, NVIDIA, Lam Research, all expected to be up there. That sector, though, only represents about 13% of the technology sector index. Technology, hardware, and equipment, this is where Apple lies, represents about 19% of the index. Apple's the largest company within this sub-industry, and this quarter, Apple's earnings results are expected to account for 15% of the tech sector's earnings. Software and services bears the rest of the market cap of this group, earnings growth of 15.6%, below that of the overall index and below that of the information technology sector. But as Sam mentioned, some of those stocks are still outperforming this year. So turning to the next slide, the thing about technology sector outperformance is these, from an earnings perspective, that is, they beat quarterly earnings estimates pretty much going back for several years. On average, over the last 2 years, the growth, you can see that the growth rate, the orange is what the actual numbers are, the green or the blue is what estimates were going into the reporting period, and you can see they've been beating by a significant margin over the last 2 years, 8 quarters. They've on average posted earnings results that are 770 basis points better than the initial expectations. But if I look at just the last 4 quarters, which is the last 4 sets of bars, you see how wide the margins have widened. The results have come in about 910 basis points better than average in each of those 4 quarters. Semiconductors have been a strong driver of this. It's been a sector that I think a lot of tech analysts have been waiting for a slowdown to occur as pricing pressures entered the market, but that just simply hasn't been the case. We expect, like you saw on the last chart, semis to continue to be a key driver of growth in this sector. Now moving along to the energy sector, we got a breakdown here. Like I said, 140.5% growth is the best in the index for this quarter. The numbers have moved up substantially, over 1,000 basis points in the last 6 weeks. Remember, I said the S&P 500 numbers moved up about 50 basis points. Well, this is a key driver with 1,000 basis point move in the last 6 weeks, and that's really been driven by the increase in oil prices that we've seen. Oil has moved up 40% more than 40% in the second quarter on average on a year-over-year basis. Key drivers, though, of the energy sector is the E&P and the integrated companies. They account for 70% of the market cap within this group. That would be included in the oil, gas, and consumable fuels bar here that is expected to post growth of 144.8% in the second quarter. Exxon and Chevron, of course, are huge components of this group. They are expected to report earnings on July 27th, so it's going to be a little while before we get numbers from this sector, as none of these companies have reported so far. The other large companies, there's about 16 of them within this bar, include ConocoPhillips, EOG, Anadarko. They're also expected to post robust earnings growth. The energy and equipment services segment, that group, still 86.7% growth is quite impressive. They're coming under a little more margin pressure more recently, but still should do well on that group, on that sector, and our sector analyst has a neutral rating on the services company. Digging a little more deeply into the energy sector, here's a chart that shows the energy index price versus WTI oil prices, and you can see they move pretty closely together, but even more deep of a relationship is between WTI oil prices and earnings for the energy sector. When you do the math and you look at the correlation, you have about a 0.90 R squared between WTI oil prices and earnings. Like Sam mentioned earlier, expectations are for oil prices to average about $68 a barrel this year. That, you know, we're well above that right now. And I think this morning I saw an oil WTI at about $77 a barrel. That's going to bode well for this quarter, and, you know, to the extent it stays in that range going forward. But the oil price increase really has been supply driven. You know, OPEC had cut their output in early 2017. There's expectations for them to begin increasing that now, but there is speculation in the market that the increase in output is not being offset by the decrease, the involuntary decreases in some countries like Venezuela, Libya, to name a few. There's also major questions about what Iran's output is going to be going forward, given the implementation of U.S. sanctions on that country. And of course, here in the U.S., while the energy space has been quite prolific, the Permian Basin, though, is having some issues exporting the oil that they have pulled out of the ground there. So we do think that that all supports higher oil prices and thus higher energy earnings going forward. And now, with that, I will pass it on to Todd Rosenbluth to talk about some of the ways you can play these sectors with ETFs.
Thanks, Lindsay. Great to be part of this overall team on this effort. I'm going to talk about sector ETF investing. Well, I'll piggyback on some of the themes that Lindsay highlighted, specifically technology and energy. But before we get into specific ETF recommendations or ways to play that, let's just talk about what's been going on from a flow standpoint. Increasingly, investors are using ETFs to get exposure to some of these sector themes, and it really has been a tale of two quarters. You know, we saw financials and materials being some bright spots within the first quarter of 2018, and I believe we touched on those sectors in the past. We've really seen energy pick up the pace, in part tied to the oil price spike, and technology really continue to deliver, you know, down slightly quarter to quarter, but still an impressive inflows taking place in the technology sector. Financials, as you can see here, actually experienced outflows, giving up a lot of the gains that they had in the first quarter. As we move here to the next slide here, just to remind you the way that we at CFRA have been rating ETFs. We're coming up actually on our 10-year anniversary in October of 2018. And the way that we look at ETFs is different, I think, the way than others that are doing so. We're believers that past performance is not indicative of future results, and what is going to drive an ETF going forward are the holdings inside and the costs that you bear when buying or selling an ETF. So we rate over 1,100 equity ETFs, a total of 1,400 total ETFs when you include fixed income, and we do so leveraging some of the stock research capabilities you're probably quite familiar with. On the right-hand side of this slide here, you'll see things like STARS, which is our qualitative equity analyst opinions on about 1,500 stocks globally. You'll see fair value, which is a quantitative way of assessing a company's future prospects, and then some risk metrics that are holdings-based. Two that came over when we joined from S&P, the credit ratings and the quality rankings, and then the risk assessment from those same equity analysts that are there. We combine that holdings level analytics with things that are specific to the ETF. So the expense ratio, the bid-ask spread, technical analysis is done on the ETF on a weekly basis. All total, we're forming an opinion that's forward-looking, and you can see here what's contributing favorably if it's green, if it's unfavorable, as you'll see for some of the risk considerations of the sample ETF, or yellow if it's neutral. The ability to do this at a holdings level has allowed us to cover hundreds of ETFs that have launched in the last 3 years, many of them that have continued to gather over 100, 500 million in assets and over $1 billion overall. So we'd hope you'd take us up on the offer if you're not currently using our ETF research to let us know in the chat box if you'd like to learn more about that, or the question box. We'd be sure to follow up with you and give you some sample research to take a look at. Now, as we move to the next slide here, let's talk about specifically ways to get exposure to some of the themes Lindsay talked about. So I'm focusing on energy and looking at a couple of industry-oriented ETFs focused on the exploration and production side of things. We happen to be quite positive from an analyst opinion, a forward-looking opinion on many of these stocks, and Lindsay touched on some of them that are going to report, or we expect to report, strong earnings, like ConocoPhillips and EOG Resources. The iShares product, IEO, is a market cap weighted product, which means that the largest companies tend to be more represented. The top 10 holdings are nearly 60% of the assets. In contrast, there's a SPDR product offered by State Street. It's XOP is the ticker. It's their oil and gas exploration and production. This is going to have more exposure to mid-cap and small-cap companies like Energen, PDC Energy, but also have exposure to the Conocos, the EOG Resources. So the weighted average market cap is about 30% lower for the SPDR product than it is for the iShares product. And you can see on the bottom here, there are going to be differences in part tied to the holdings in both up and or down markets. XOP, the equally weighted product, in part to its small and mid-cap exposure, has a little bit more volatility. You can see that in the 2017 underperformance and then the outperformance in the nearly first half of 2018. Now, on the next slide here, I wanted to talk about the technology sector. We wanted to focus on market cap weighted products just to give you a difference here. And these are broadly diversified products. So XLK is a technology sector SPDR. It only invests in S&P 500 tech, as well as a small number of telecom services index constituents, whereas VGT from Vanguard, there's a mutual fund version of this as well, only holds technology stocks, but it also holds mid and small cap companies, and this is using an MSCI index. You may be familiar with this, but the partners S&P Dow Jones Indices and MSCI that partner together on GICS are moving companies into a new communications services sector. The telecom services sector is being renamed and reconstituted. At the risk of getting too far into the weeds on this, companies like Alphabet and Facebook are going to be leaving the technology sector and joining the communication services sector with companies like AT&T and Verizon. Vanguard has begun the transition. So if you look at VGT today, it has less exposure to the Alphabet constituents and Facebook than a traditional technology ETF. It's starting to pare back exposure to that and increase exposure to companies like Intel and Cisco that are staying within that technology sector. And we'll have more of that on upcoming presentations, I believe. But you can see here again, whether you have small and mid-cap exposure or you have an additional telecom exposure, you'll see there are differences in the performance. And even though VGT, is slightly cheaper, the performance record is notably different. 300 basis point performance or outperformance of XLK in 2017, in part because telecom services was a significant underperformer in the group. And as I move to the next slide here, I want to bring back in Scott Kessler. Scott covers a number of the technology stocks that we're showing here. Scott, I thought it'd be useful, since we, from an ETF perspective, are using the stock research that you and our colleagues have, maybe for you to highlight a couple of stocks that we're very bullish on in the space.
Yeah, thanks a lot, Todd. I've actually headed up the business's technology sector equity research efforts since, I think, 2004. So it's been a long time. As indicated here, we currently have around a dozen strong buy recommendations covered by our U.S. equity analysts. I think what's interesting about this list is that it's pretty diverse. We tend to look at technology in 4 primary buckets. I think there are like 15 sub-industries, but we tend to look at the sector based on semiconductors, hardware, software, and services. You see representation from all those areas within our strong buy opinions. As an aside, our strong buys account for roughly 7% of the technology stocks that our team covers. But if you include buy recommendations, that rises to about 1/3 of the technology companies that we cover. We always try to be actionable. What I would say about this list is that you have some of the largest companies in the sector in the world in Alphabet and Oracle. Those are both top 10 market cap companies in the technology sector. In addition to that, you have representation from semiconductors and Broadcom, as well as IDTI, Integrated Device Technology. You have representation on the hardware side with CommScope and Fitbit. Admittedly, those are smaller cap names, and that really speaks to the fact that we look for opportunities in a variety of different shapes and sizes, so to speak. And then I'd say it's fair to characterize our orientation to the technology sector as more heavily weighting those companies that are considered later cycle companies that are going to perhaps benefit from what happens in the latter stages of an economic recovery. And so in that category, we would put software and services, and you have, as I alluded to, Oracle, as well as a couple of design-oriented companies focused on semiconductors within our strong buys and buys. Synopsys is one of those companies. Another one is Cadence Design Systems, which is a buy opinion. In addition to that, we have a number of services companies highlighted here, from Cognizant Technology Solution to DXT Technology to Leidos Holding. So it's a really diverse group. The last thing I would say is if you want more information about these names displayed on this slide or other technology sector buy opinions, I strongly encourage you to reach out, and we can provide you with samples or perhaps a trial to access some of our research. So with that being said, if we go to the next slide, we've wrapped up the substance of this presentation. I wanted to make sure that before we transition to the Q&A portion that I highlight, and I'll leave this slide up for your reference, that we're going to be doing in a little bit more than 2 weeks, a webinar on active versus passive, for lack of a better characterization, a mid-year review and an outlook. My understanding is that Todd Rosenbluth is going to be the primary speaker during that call. I would plan for that, and if you have questions in advance, you can let us know. So with that, and I'll leave that up just so you can reference that as we talk, we have received a number of questions during this call and actually even prior to the call. So thanks for those. I think the first question that I think I'll pose to Sam and Lindsay at this point came in, which I'm going to paraphrase. Why isn't the market going much higher with the significant growth in earnings that we've seen?
Sam here. Well, I would say it already did, that it was in anticipation of an explosion in corporate earnings as a result of the tax reform of 2017. It's almost like a carrot luring the investors forward. Once the president had been elected in November of 2016, we had a near 20% gain in prices in 2017 in anticipation of the changes that would be taking place. And so what we're getting right now is sort of a confirmation of what had been anticipated by investors and built into equity prices. And now we're looking at valuations that are lofty, a rising inflationary environment, as well as a tightening program that will continue by the Fed. And sorry, Lindsay, if I took all of your talking points.
I think you covered most of it, and I would just point out that the market also looks forward to, it's always forward-looking, so even though we're getting over 20% earnings growth in this year, 2019, we're expected to see a deceleration of 9 to 9.5% growth. So that is also a factor that is being taken into consideration, as well as you have to remember that these tariff and geopolitical and political concerns all over the world continue to have an impact and perhaps create a cloud over the market, in my opinion.
All right. Thanks a lot. So we are getting a number of questions, and there are, I guess, a number of them related to the energy sector. And I guess, Todd, this is a question obviously for you, which is, can you highlight any recommended ETFs broadly related to energy, equipment and services, oil and gas, consumable fuels. I think they're just broad question on energy ETFs in general that we're currently recommending.
Yeah, so I'll take that in a couple of different ways. One, we like the Energy Select Sector Spider, which is XLE, which is the S&P 500 energy constituents. Exxon and Chevron combined are nearly over 30% of that portfolio, and so our view on those stocks is indicative of that, and Lindsay talked about from an earnings perspective, those companies are reporting later on this month and are expected to report strong results. Our view on the energy services sub-industry or industry, I think, is less bullish than it is on the equipment and production and the integrated space. I'm not the analyst that covers that, but IEZ, which is the iShares Equipment and Services ETF that we cover with an underweight rating, and we do so in part with a negative view on the stars of the portfolio. Some folks may want to look at MLPs, and so we cover those and carve that out as its own search category. And so as I look here on the fourth page of the ETF report, and I encourage folks to take a look at that as a nice cheat sheet, that's there, Global X, MLP, Energy Infrastructure, MLPX, and the First Trust North American Energy ETF, EMLP, are the two highest rated ETFs that we have from within there. So a mix of where it is, of course, just because the earnings trends are going to be positive for the sector doesn't mean the valuation prospects are as strong. Lindsay, I don't know if you have anything you want to add to that from just broadening from an energy perspective.
I mean, I would just say that energy earnings outlook still remains strong because, like I said, the earnings recession experience within that sector was very deep. And I think as long as oil prices remain at an elevated level, or even the $68 target for this year and next year on WTI, I think this is a group that will continue to do well. I think the other item that might be worth looking into when thinking about the energy group, or maybe perhaps when to get out of the energy group, is looking at CapEx projections for the companies as they move forward.
Yeah, that was great, Todd. You obviously saw that someone asked also about MLP ETFs, so it's great that we've already addressed that question before it was even asked. So there are a couple of things I wanted to clean up really quickly. So first, we have a positive fundamental outlook on the oil and gas equipment and services sub-industry. A few of the names that we have buy recommendations on include Baker Hughes, which is ticker BHGE, as well as Halliburton, which is ticker HAL. You can access that on our MarketScope Advisor platform. If you are not currently accessing MarketScope Advisor, you can go to trymsatoday.com, or you can reach out to us directly to start a trial. So a couple of questions have come in around the notion of tariffs and trade wars, and whether or not we have seen, maybe Lindsay, this is a question best posed to you, whether we've seen estimates maybe not going up as much as we normally would expect, or maybe companies being a little bit less optimistic in terms of the guidance they provide. Have we gotten any sense from the companies at this point, or the estimates, that the tariffs and potential trade war is having an impact on how the way these companies are operating is going to change?
I think the commentary that we've heard so far from the few companies that have reported have provided very general commentary with regards to trade and tariffs, because it's still kind of difficult for many of them to actually quantify. We have seen numbers for the second half of 2018 and into 2019 move slightly lower. In the last 2 weeks, the third quarter and fourth quarter earnings growth numbers have come down by about a percentage point, perhaps in anticipation to tariff talks leading to lowered guidance. But like I said, so far the companies that have provided guidance or pre-announcements have all provided, not all, but the majority have provided increased outlooks or improved outlooks. I think that it'll be definitely something, probably the hottest topic on all earnings conference calls this quarter, and it'll be certainly something we keep a close ear to as we progress through the quarter and as well through the year. The $34 billion that have been imposed on China's goods and on our goods from China's perspective is a very small percentage from when you think about it on an economic perspective, from a GDP perspective, but there will be real impacts, and you're already starting to see that in some commodity prices as well as the prices of some goods, especially within the aluminum and steel space. So it's something we definitely have to keep an eye on.
Great. Sam, this question came in for you. Aren't you concerned about rising rates and an inverted yield curve putting pressure on growth projections? And my kind of additional comment on that is it has been something that I've seen more about in the last couple of weeks. It's interesting because I think a lot of folks, including us, have been anticipating a steepening yield curve with higher rates benefiting, let's call it economically sensitive companies in the financials area and the materials area. But now people are talking about the possibility of an inverted yield curve. So how do you kind of square those two perceptions, and what do you think is going to happen?
Well, Scott, as I wrote back on May 21st in my Sector Watch piece, Rates and Returns, basically going back in time and saying, all right, let's put everything into perspective. I think one thing that makes this period different from what we have seen in the past is how low interest rates were right from the beginning. Historically, the Fed funds rate is about 1.3 percentage points above the rate of inflation. So investors realize that we are in a net negative real rate environment, which means that interest rate monetary policy is very stimulative at this point because interest rates are below the rate of inflation. If we get another rate hike this year, that will bring us to a net neutral environment, and then the further we then go back into a positive environment. However, we still normally should be seeing the Fed funds rate at about 3.5+%, which is about a percentage point above where we think the rate will be by the end of 2019. Also, history implies that we normally start to see the stock market decline, but it has to be more along the lines of a 6% yield on the 10-year note. I think that maybe investors will get a bit more spooked the closer we get to maybe 4 or 5%. We won't be waiting until 6%, but still, it's going to be higher than where we are right now. Historically, going back to 1960, we have traditionally seen three things that point to recession. And investors have worried most about recession as it relates to bear markets. 2 out of every 3 bear markets has been accompanied by recession, and then the other bear markets were out of fear of recession. The 3 things that I've looked at: housing starts. Every recession since 1960 was preceded by a year-on-year decline in housing starts that averaged 25%. The most recent reading for housing starts was a gain of about 10%. Consumer confidence is very important, usually about a 10% decline year on year, but we're in positive territory. And then also we've traditionally seen an inverted yield curve averaging about 60 basis points in the quarter before a recession starts. Right now we're positively sloped, but by an ever shrinking amount. Right now it's about 30 basis points. So one reason that Lindsay and I reduced our recommended exposure to the financial sector is that historically in a rising Fed funds rate environment, the yield curve narrows. It does not widen. And as a result, when you have interest income for a lot of these more regional banks, which tend to dominate the financial sector, they see their profit margins get squeezed. So should we move into an inverted yield curve environment, that would not be healthy, because what would be the incentive for banks to lend money? Typically they borrow at a lower savings or checking account rate and then lend it out at a more expensive mortgage rate, and the difference is their profit margin. But if it's going to cost them more to borrow money than it is to lend, then basically they say, well, we're just not going to lend, and that's when economic growth tends to slow.
Great. That was an awesome answer, Sam. So I see that we're getting close to the top of the hour, so we're going to take probably a couple more questions. Todd, this one is for you. I think Sam talked about an acceleration of volatility, and the question asks about some ETFs that provide a lower volatility approach. I guess there are products that have been developed and are investable that try to capitalize on that theme.
Yeah, so in addition to broadly diversified ETFs or sector or industry ETFs, there's a growing number of either known as smart beta or factor-oriented ETFs. A popular area is focused on lower volatility. So these are equity exposures with the least risky stocks within the broader index. So the Invesco product tied to the S&P 500 uses a ticker or has a ticker SPLV. That's the 100 least risky stocks within the S&P 500, and it's rebalanced on a quarterly basis. USMV comes from iShares. It's a minimum volatility ETF. The major difference between those two products is that USMV has sector constraints or bans, so it can only go up or down versus the broader sector or the broader exposure at the sector level. So, for example, there's about 20% exposure to the technology sector for USMV, but companies like Visa that are lower risk stocks within the technology sector you can find exposure to, whereas SPLV offers less exposure to tech and more exposure to some of the more defensive sectors like consumer staples and utilities. And those are two firms, iShares and Invesco, that offer that, but we've seen new products come out from JP Morgan and Oppenheimer and many others that are now offering a flavor of low volatility strategies.
Great. And I think the final question that we're going to take, Lindsay, is probably for you. It's related to the industrial sector. You had referenced this earlier. Someone had reached out basically asking about our expectations for the industrial sector, referencing, I think like you did earlier, that, it had underperformed, and kind of how are we thinking about that for the balance of the year?
Yeah, I mean, I think that the reason we stay overweight industrials, even though it's been a tough sector to be overweight so far this year, is because given we're late in this cycle, we see this as a sector that could do well. Earnings expectations have been coming down, but we think that the tariff talks have been a huge they've been a huge weight on this sector especially. And once we get past these talks, which we view as negotiating tactics by the Trump administration, this is going to be a sector that most likely jumps once we get into the clear. But the uncertainty could make it more difficult at this time to get involved for those that might be of the faint of heart. But we do think that the group has just been significantly oversold. Valuations have come down significantly, and we think there are opportunities and that will be rewarded later on down the road.
Great. And I'd point out that we have buy recommendations on a number of, or strong buy recommendations on a number of industrial stocks, from some of the airlines like American, Delta, to some of the logistics companies, FedEx and UPS, to some of the more traditional industrials names like Caterpillar, to some of the defense names like Lockheed Martin. So that wraps up today's webinar. On behalf of the team at CFRA, we would like to thank you so much for joining us. We hope you're going to join us again, as indicated previously, on a webinar coming in a couple of weeks, active mutual funds versus index ETFs. Until then, if you have any questions, please don't hesitate to contact us. I think the best way to do that is probably at cservices@cfraresearch.com. Thanks a lot.